Hi everyone, welcome to this video. Today I'm going to be showing you a beginner's guide to forex trading in 2026. Forex trading is basically the largest financial market in the world, and it processes over $7 trillion in transaction every single day. Most beginners try to trade and they lose all their money even before they develop any clear trading plan, but this does not have to be your story. My name is Michael. I've been trading for the past 3 years, and today I'm going to show you how to trade in 2026. This year alone, I've made over $20,000 in prop firm profit. So what are you going to learn in this class? The first thing that you're going to learn is going to be what is forex and how does the forex market works. The next thing is going to be the basic tools you need in order to start trading. The next thing is going to be when to trade, when are the market sessions open. The next one is going to be the two main types of forex analysis you need before you can start trading. Next one is going to be core forex terminologies in forex trading. Next one is going to be risk management and money management. The next one, trading psychology and routine. Next is going to be how prop firms work and what they really are. And then the last one is going to be how to avoid scams in the forex market. By the end of this class, you're going to have a clear roadmap to how to trade in 2026 and a structured and disciplined way. So let's dive straight to it. The first one, what is forex trading? Forex simply stands for foreign exchange. It's a global financial marketplace where national currency is being exchanged for one another. Forex trading is the largest financial market in the world, as I said earlier, and it processes over $7 trillion in transaction every single day. So in the forex market, you are always dealing with currency pairs. You are either buying one or you're selling the other. So in forex, you never buy a single currency pair on its own, a single currency on its own. You always have to buy them or sell them as a pair. Taking for instance Euro USD or GBP JPY. So there are 7 major currency pairs that we're going to focus on. There are 21 others. Basically we have like 28 tradable currency pairs, but we're going to focus on just 7, which is Euro USD, GBP USD, USD JPY, USD CHF, AUD USD, NZD USD, and USD CAD. We are focusing on them basically because they are easier to trade, they have high liquidity, meaning execution is easier and faster, and then low spread. So the next thing we're going to learn is how does the forex market work. So I listed 7 currency pairs earlier, and then basically each currency pair on the left side is the base currency, and then the one on the right side is the quote currency. So for instance, Euro USD, if you think Euro is going to be strong against US dollar, so you basically buy Euro USD. But if you think Euro is going to be weak against the US dollar is going to be strong, then you're going to sell Euro USD. So you always have to trade them as a pair. So the third thing is the core tools you need in trading in 2026. So the first one is the chatting platform. The second one is the connection to the market, that is a broker, and the third one is going to be the execution platform. So the first one, the chatting platform, is called TradingView. There are other ones, but TradingView is the widely known one that people use. So basically you use it to identify trends, if it's either trending upwards or trending downwards. So wherever the trend is going, that is where you try to join. Meaning if a currency pair is buying, you try to buy it, or if it's selling, you try to sell it. You use it to draw support and resistance line, basically where you think demand and supply is going to hold, and then use it to test strategies that you're going to use in trading. You also use it to mark key levels and set alerts in trading. So the second one is going to be a broker. So the broker is where you put your money, you deposit your money, and then that's where your capital is going to sit. and they are going to be the one to provide you with the trading connection to the global financial market. So basically, you need to do a deep research before you choose a broker, because you need a broker that is regulated by the financial authority in your region. You need a broker that has a clear and a transparent fee policy with good reputation and withdrawal policy. So the third one is going to be the execution platform. There are so much execution platform like cTraders and all, but the major one is the MetaTrader 4 or 5, but the most recent one is MetaTrader 5. So you need a MetaTrader 5 to connect to your broker. You can trade with the broker directly, but it's advisable that you use a connection platform because it's easier to use. So the fourth thing you're going to learn is the market sessions, when to trade. The forex markets opens 24 hours in a day and 5 days in a week. However, not all hours are the same because there are different times in different countries. So you have to know the exact time that you want to trade. So there are 3 major sessions. Some say 4, but basically we're just going to say 3 major sessions: the Asian session, also known as the Tokyo session, London session, and the New York session. Some includes Sydney sessions, but these 3 are easier to understand. So the Asian session usually opens from 7 p.m. to 4 a.m. New York time, and then the London session usually open 3 a.m. to 11 a.m. New York time, and then lastly the New York session opens 8 a.m. to 5 p.m. New York time. So you just need to identify which session flows with the currency pair you want to trade and the time in your country. So the next one is going to be types of analysis. So people do say there are 3 types of analysis: fundamental, sentimental, and technical analysis, but we're just going to focus on 2 major types of analysis. The first one is fundamental analysis, and this is the why behind the market, the reason why the market is moving. So fundamental analysis focuses on economic and geopolitical factors that influences currency values, such as central bank interest rates and decisions, the inflation data, e.g. CPI, consumer price index, employment reports, non-farm payrolls, which is basically NFP, gross domestic product, which is basically GDP and figures, and then political events, geopolitical tensions, and war happenings around the world. So you need basically news tools in order to have this kind of analysis. An example is an economic calendar like Forex Factory or My FX Book. We're going to see all the lists of the news that are coming out that may affect how the market is going to move. So the basic guidance behind this is that you need to avoid entering into trading when a high impact news is about to happen, because if you are not an expert in that field, you are going to lose money because the market moves very volatile at that time. Majority of people use the second type of analysis, which I'm going to mention, which is the technical analysis. That is what most people use because they are able to determine the direction of markets in terms of analysis. So that leads us to the second type of analysis, technical analysis, which is basically price action and chart study, how to study the charts. Okay, so the first thing here is the chart to use. Some use line charts, some use bar charts, some use candlestick charts, some use different type of things, but we're going to be focusing on the widely known one, which is the candlestick pattern. So you're basically going to see the markets moving in candlesticks, and we're going to explain what they are. You're going to see how these candlesticks make like market structures, basically highs and lows, supports and resistance level, trend lines and channels, and then there are indicators. There are indicators that help you understand where the market is going. They just guide you through what you should be looking for in the market. So if you can learn how these price actions work and you can develop an effective strategy, then basically you can use technical analysis to trade. So the sixth thing is going to be the core forex terminologies you need to know. So before attempting any live trading, you need to know all the terminologies. You need to know the basic things in forex. Example is pip. So the tick, how price move from one place to another, is basically called pips. So if the market moves like a far distance, you calculate that distance in pips, basically like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 pips, like that. So basically that is what a pip is called. It is used to measure the distance of price on the chart. The second thing is going to be lot size. So lot size basically means how much you want to use in buying a certain currency or selling a currency. So basically there are three major lot size: standard lot size, mini lot size, and macro lot size. So a standard lot size is basically 1.0, and then a mini lot size is 0.1, and a micro lot size is 0.01. So this is going to determine how much you're going to make or how much you're going to lose when you want to trade. So this has to be studied. You need to know the exact lot size to use as per your account balance. The next thing is going to be a leverage. Leverage is basically a loan your broker allows you to use in trading. So as I mentioned earlier, that the market processes over 7 trillion in transactions. So not enough people have enough money in order to be able to trade, but the broker helps you with more money to be able to make more money or lose more money. So basically leverage is just like a loan that is being put forward to add to whatever you deposit. Let's take for instance, you deposit $500 there. Broker can add up to times 10 of your money just for you to trade, but that money they are loaning you is just to trade. And then if you make more money, is all yours. But if you lose money, once you lose your initial deposits, they're going to withdraw their own loan, and then that is going to be. So that is basically what leverage is. And then bid, ask, and spread. So the bid is basically the price at which the broker is willing to sell, and then the ask price is basically the price at which you're willing to buy. So if, let's say, you bought something from the market, is basically the bid price, and then if you want to sell it back, you have your own ask price. So it's not going to be the same amount that you bought it that you're going to sell it. So basically that is how the currencies are. The amount you're buying it is different from the amount you're going to be selling it. So the difference between them is called the spread, and that is where the broker gets their own money from. So if you want to buy a currency in the market, if you're buying at a different price, and then if you're selling back, you're selling at a different price. The difference is what the broker uses. So those are the basic terminologies you need to know in forex trading. Every other terminology you can always learn them, like margin and things like that, but these are the major things you need. And then next is going to be risk management. It is very important in trading. So this is the part that separates traders from gamblers. Most people think trading is gambling, but risk management is where it draws the line between trading and gambling. So many beginners focus on only how to win, while professionals focus on how not to lose big. It is advisable that you risk 1 to 2% maximum on your account, which is called the 1 to 2% rule. It is widely used as a guidance for people to know exact amount to risk. So let's take for instance, you have a $1,000 in your account. If you take a trade, you shouldn't lose more than $10 to $20 maximum on each trade. So you're going to trade up to like 100 times before you lose your account. So basically that is what the 1% to 2% rule is. So if you inculcate this kind of risk management into your trading plan, then you're definitely not a gambler because you manage your risk. The next thing is basically risk to reward. So it is advisable that you try to make more than what you are losing. If you take a trade and the trade goes against you, it should be smaller than when you win. If you take a trade and then it goes in your favor, then you should make at least like ×3 or ×2 of whatever you're losing. So there is an instance of 1:1 risk to reward, meaning if you place a trade, you risk $10, then you're going to make $10. But there's an instance of 1:3. So if you place a $10 trade, you're going to lose $10, but if you win, you're going to win $30. And then you have to determine which risk to reward you can choose. You can take as high as you want, like 1:1, 1:2, 3, 4, 5, 6, up to 1:10 or more. So the next thing is going to be trading psychology. The technical side of trading is often the easier part, but the real challenge is managing your own emotions and behavior, and that is where trading psychology comes in. So the first thing is fear of missing out. Most times, whenever you see a green candle shooting up, you see the opportunity to make money. So you think the market is going to keep moving. So you forget about making your analysis and then you jump into the market without even making any analysis because you don't want to miss out. And that is the number one problem in trading psychology that people face. So you have to know how to plan to avoid fear of missing out in trading. The next thing is revenge trading. Most people, when they take a trade and then they lose the first one, they want to quickly make it back because they feel they've lost money and they want to make it back, instead of them developing a clear plan that they can use in trading. That is called revenge trading. So once they lose, they try to make it back, and then they eventually lose all their money. Another thing in trading psychology is boredom and patience. Most people feel bored whenever they are practicing patience. When you've already analyzed the market and then you're waiting for the market to come into your already marked out zone, but because you are impatient, you just want to trade with the market without waiting for it to come to your price, and then you jump on the markets and you lose money. So all are these all factors that are always accumulating into trading psychology, and then once you keep making this mistake after the other, you eventually get your psychology all ruined, and you can never be a good trader if you do not have your psychology in check. So the next thing is going to be routine and journaling. So one of the most important parts of trading is journaling. You need to have a routine that you do every day. If you wake up, you probably pray first, you work out, and then you have your time for trading. You follow that road. It helps you practice discipline if you have a routine. And then journaling, whenever you take a trade, if you win or you lose, if you journal it down, you write it down, then you learn from the mistakes and then you learn from the good parts that come out of your trading. Is a good habit. You can use different forms of journaling. You can journal manually, you can use Excel or Google Sheets, you can use Notion, you can use different things in journaling. The next thing is money management and prop firms. So to manage your money, you have to learn capital protection. You have to try and protect your capital and then capitalize on your interest. Whatever you deposit into a broker, you have to try and protect it first using proper risk management instead of trying to make get rich quick. That is basically you have to grow your account gradually instead of trying to max out and blow your account. So basically that is what money management is. You have to inculcate proper risk management, as I mentioned earlier, risking 1 to 2% per trade. So you have to grow gradually. That now brings us to prop firms. What are prop firms? Prop firms are proprietary firms, and example of a prop firm is FTMO, Funding Pips, etc. So prop firms are like companies that provide you with an account. Most times that account is a demo account. It's not like in the real market, but it's exactly like the real market. So you use it to learn how to trade. You have targets. They say try and make like 10% of the account. They give you like a $10,000 account or $100,000 account with a small fee. Let's take for instance, if you want a $100,000 account, you're going to pay like $500 or thereabouts. If it's a $10,000 account, you're going to pay like $50 to $60 thereabout. But if you can make 10% without losing 10% on that account, using proper risk management and then other rules that they've provided, if you pass that account, some they have one phase, some have two phases. So you pass phase 1 and phase 2, and then they're going to give you an account that they call a funded account. So whatever you make on that account is going to be yours. So let's take for instance, you only invested $500 and then you pass that account and they give you $100,000. That is a whole lot of money, and then whatever you make on that account is yours, as long as you don't lose more than 10%. So you don't lose more than 10,000 and you can make any amount. That is basically what PropFirm is. So if you are not willing to risk your own money, or you do not have up to $10,000, because if you have, let's say, $1,000 now, risking $10 and then aiming for $2 or $3, $20 or $30 is really small, and then that's why people try to make more money and then they blow their accounts. But if you use PropFirms, it basically gives you more access to capital, and then you can practice proper risk management on those accounts, and basically that's what PropFirms are. But with PropFirms, you have to know that they have the rules you have to adhere to, and then you have to use proper PropFirms like FTMO and other PropFirms like 5%ers that have been in existence for a very long time, because some PropFirms are out there to just scam you. Whenever you pass and then you try to withdraw, they never pay. And then if you have your money enough capital, you can use brokers. So the last but not the least point I'm going to say is going to be avoiding scams. So how do you avoid scams in trading? The first thing is going to be anyone offering you guaranteed returns, unrealistic, saying if you deposit $500, they're going to flip it for you in the next 1 week to $5,000. That is a pure scam, because it is not consistent. It can be possible for the first time, but it's not consistent. You cannot consistently do that in the forex market. It's basically like gambling, trying to flip it into 10 times in a very short period of time. So basically you have to avoid anyone promising you high return on forex trading. And then there are other people providing signals. They do not have the knowledge to provide you signals, but they take some money from you and then they provide you with signals, faulting you that you never use proper risk management, and that is really fraudulent. And then the next thing is going to be people selling bots. They're going to tell you, oh, they have a bot that is 100% win rates, and there is no strategy that is 100% win rates. And those are the basic types of scams you're going to see in forex market. But if you know how the forex market works already, and then anyone is promising you all these things, you know that you just have to avoid them. And basically that is what forex trading is all about. So I've just tried to summarize what forex trading is. Forex is more deeper than this, but this is the easiest way you're going to have an overview of what forex trading is. In my next video, I'm going to be breaking it down and then putting it all together for you to understand what forex trading is. Thanks for listening till the end, and I'll see you in the next video. Bye.